Okay, greetings out there. A couple of things came up in class today. One was a question about Treasury stock and how you make the entry for that. I said that what you do is you take the entire amount that you pay for the stock and you just book it to Treasury stock, which is what this cost method example illustrates. And by the way, this will be covered in Intermediate 2. And so the first whole approach to this is whatever you pay at the time you pay for it. Remember, when you go buy your stock back off the market, if it is publicly traded, you're going to pay what the market's paying. So you may have issued the stock for a fraction of the cost that it's valued for today, or it may be something a lot lower. It all depends on where the market has gone. But at any rate, the cost method just merely takes it and puts the whole amount in the treasury stock. Later on, if you were to resell that, because that's what treasury stock means that the stock has been shelved temporarily by the company. It's as if they're buying their own company as an investment. So later on, they could sell it. And in this example, you can see where they sell it for more than what they paid for it. And so they're going to put that not as a gain. They won't put it as a gain on their own stock, but they'll put it to additional paid-in capital. And of course, what they're doing here in this entry is they're getting rid of the treasury stock when they sell it by wiping it out this way to zero, and the additional amount that they get goes to paid-in capital. That may be one reason why companies buy their own stock when the price goes down. They figure it's a good situation to buy as like an investment, and on the theory that they can raise more capital a second time around when the stock value goes back up. The board could elect to retire the shares out of treasury stock, in which case it's the same concept. We're no longer going to shelve those shares. We're going to legally take the shares out of the ability of the corporation to issue them, so there'll no longer be outstanding shares. And the entry then again would be to, in this case, get rid of the treasury stock that they booked initially by zeroing it out and putting to the common stock based on the par value and the additional amount that's above the par value to additional paid-in capital. This part of this entry you should really understand how these numbers break down, because this is going to be part of what you're going to need to do over the course of the next weeks of this course. There's one other way, which I won't go into or belabor too much, but it goes along what was brought up in class, as an astute student asked, is, well, what about if you're just, what about an entry where you actually reverse what you did when you initially offered the stock for sale? And that's what this constructive retirement method is doing, which you go back to how you issued it initially, and you retire it exactly as it came in, exactly as you capitalized it, and the difference, whether it's debit or credit, would go to retained earnings. So you can look through that to get an idea what that's about. If you're not interested in doing Intermediate 2 right now, which I wouldn't blame you for, then you might want to skip to the next one, which is this. And that's called preferred stock. I just want to go over preferred stock and its meaning. This is one of the great things I mention all the time about accounting. You should just learn so much, and you got to learn so much in order to understand how to book things into the books and reflect those on the financial statements when they need to be reflected. And you learn things about items in economics which aren't going to be on the books, because you just got to know everything about the company you're working for. Preferred stock, you can read through it. It's a type of stock where it's sort of in between bonds and common stock. It has a priority over common stock. That's a key term, but it's not senior to bonds. It's subordinate to bonds in terms of claims or rights. And that's one key part of what preferred stock is all about. And if you want to get a better idea, when it comes to creditors coming after the company, the bondholders come first, meaning that whatever money's left over after the creditors are done, whatever money's left over goes to the bondholders. If there's any money further left off, it goes to preferred stock. And last in line are the common stockholders. So in liquidation, that's the best way to describe it. In liquidation, any cash after paying off all the creditors goes to the bondholders. Check. If there's any further cash, it goes preferred stockholders, and then common stockholders are last in line. And so that's the order of the terms of claim or priority rights that exist in liquidation. And finally, when it comes to preferred stock, they have a preference in dividends. It's usually based on some type of a negotiated or contractual rate of return. And what happens is that the preferred shareholders get first dollars to pay whatever rate they're supposed to get. So to the extent that there are enough dollars to pay the preferred shareholders, let's say it takes this amount, so they'll get their preferred rate, and their dividend, and then the rest goes to the common stockholders if any's left over. And there's two types, and this is what you need to know for this course. You're going to need to know it. There's cumulative and non-cumulative preferred stock. Preferred that's cumulative means that if we miss paying a preferred dividend, it accumulates, and when we have the ability to pay dividends in the future, the accumulated missed amount has to be made up first. And the non-cumulative, which we'll put in green, is if you miss, it's just sort of too bad. Read the explanation, and it doesn't mean too bad means it doesn't accumulate. Read the explanation for this further. If you have any questions, check the checkbook. If you have any questions beyond that, check with me.